Greetings to everyone, we are from Group A5 and today we will be presenting our assignment 1. The underlying asset selected for this analysis is Intel Corporation INTC, where the real option data were collected from Yahoo Finance on 1st May 2026. The selected options have an expiration date of 8 May 2026 and consist of call options with several strike prices, including 35, 36, and 37. The data set includes the underlying stock price, strike price option premium, bid and ask prices, trading volume, open interest, and implied volatility.
We will use the call option values for Intel Corporation. This data exhibits exceptionally high implied volatility, with many out-of-the-money strike premiums trading at IV levels well over 100%. Buying a single call here would be risky because if the market calms down, the option price will crash. Entering a straightforward long call in a high IV environment would also severely penalize the investor. By the volume and open columns, we can also conclude that there are plenty of buyers and sellers at these strikes, meaning you can get in and out of the spread easily without losing money to wide bid-ask spreads.
Referring to the historical data of INTC call prices, we will be assuming a moderately bullish market, implying that we anticipate a steady rise in the underlying assets price through not with an extremely steep or aggressive increment. Thus, we are betting Intel's price will be above $105 by the time options expire in 2026. With this assumption in mind, we plan to implement a strategy which allows us to gain realistic profit by creating a tight spread. One of the most suitable strategies would be a bull call spread. The goal is to create a spread that allows us to lower the price of a trade by selling one option to help pay for another. Thus, it makes the trade much cheaper to enter than just buying a single call option. And not only that, the strategy also protects us because our maximum possible loss is strictly limited to the small amount of money we paid to start the trade.
Next, I will explain our chosen option strategy, which is the bull call spread strategy. In this strategy, we buy one call option at lower strike price, which is 100, and sell another call option at higher strike price, which is 105, and both options expire on 8 May 2026. This strategy is suitable because it requires a lower initial investment compared to buying a call option alone. The premium received from selling 105 call option helps reduce the cost of purchasing the 100 call option. Another advantage is that the downside risk is limited and the maximum loss is only limited to the net premium paid at the beginning of the strategy. At the same time, the strategy still allows investors to earn profit if the stock price increases moderately before the expiration. And in our case, the reward to risk ratio is calculated as the maximum profit divided by maximum loss, which is 1.82, and since the ratio is greater than 1, the strategy provided a relatively attractive return compared to the risk taken.
Next is the calculation of payoff and profit for this bull call strategy. Firstly, we need to calculate the call option premium. The formula is bid price plus ask price divided by 2. Let K1 be the lowest strike price, which is $100, and K2 is the highest strike price, which is $105. So the call premium for K1 is $4.35 and for K2 is $2.575. The net cost for this strategy is $1.775 by subtracting $4.35 with $2.575. For payoff, the formula is max 0 ST minus K1 minus max 0 ST minus K2, and the profit formula is payoff value minus net cost. By using the payoff formula and profit formula above, we can build this table and determine the profit or loss gain. When stock price at expiration is less than $100, the loss gain is $1.775. When stock price at expiration is in between of $100 and $105, the profit or loss gain is stock price at expiration minus $101.75. And when stock at expiration more than $105, the profit gain is $3.225. So from this, we can know the maximum loss gain is $1.775 and the maximum profit gain is $3.225.
Now we will continue with the payoff graph analysis. This graph consists of 3 parts. The first part is when the stock price less than or equals to 100. In this part, both call options expires out the money and have 0 value, so the payoff is equals to 0. The next part is when the stock price lies between 100 and 105. In this part, the purchase 100 call becomes in the money, while the return 105 call still expires worthless. The payoff follow the formula payoff equals to stock price minus 100. The last part is when the stock price is more than or equals to 105. In this part, both call options are in the money. The payoff remain constant at $5, which is the maximum payoff for this spread. Next, we will continue with the profit graph analysis. This graph also consists of three parts. The first part is when the stop price less than or equals to 100. In this part, the profit is equals to negative 1.775, which is the maximum possible loss. The next part is when the stop price lies between 100 and 105. In this part, the profit increases linearly according to the formula profit equals to stop price minus 101.775. The break-even point is when the stop price equals to 101.775, so the investor will begin to earn profit when the stop price exceeds the break-even point. Lastly, when the stop price is more than or equals to 105, the profit will remain constant at 3.225, which is the maximum possible profit per share. Additional increase in stop price will no longer increase in profit.
Next, I will discuss the results analysis of our bull call spread strategy on Intel Corporation. The strategy produced a balanced risk-return profile under a moderately bullish market outlook. By buying the $100 call and selling the $105 call, the net cost was reduced to only $1.775 per share. If the stock price stays below $100, the maximum loss is limited to the initial premium paid. When the stock price rises above $100, profit increases gradually until it reaches the maximum profit of $3.225 per share at $105. The break-even point is $101.775. Overall, this strategy is suitable for investors seeking moderate returns with controlled risk exposure. In conclusion, the strategy lowers the initial investment cost while limiting downside risk. Based on our analysis, the maximum loss is $1.775 per share, while the maximum profit is capped at $3.225 per share. In addition, the strategy performed well in a high implied volatility environment because the written call helps reduce expensive option costs. Overall, the bull call spread provides a practical and cost-efficient strategy for investors seeking moderate return with controlled risk.